Hello everyone, this is Professor Chandana Goswami from Tejpur University, and today we will be talking about the evolution of central banking and the Reserve Bank of India, which is our central bank. So how did central banks evolve? The primary stimulus for establishing central banks in many parts of the world emanated from exigency of war financing. War financing also led to nationalization of many central banks, which were till then functioning as private entities. Once the war was over, the role of central banking came to be increasingly focused in mobilizing resources for planned development and tackling high inflation. Central banks have responded to their contemporary economic scenarios and adapted their functions or roles in line with the evolving times. In the initial phases of development, the role of central bank was limited to lender of last resort. In most countries, they were given the monopoly of note issue. This was necessary because wherever multiple organizations were involved in note issue, there were problems in terms of controlling the quantum, quality, and acceptability of currency issued. Later on, the central bank shouldered the responsibility of maintaining a stable external value of money, that is the exchange rate. You can have a look at this table, which will give you a fair idea of when central banks were established in which countries. It goes back to 1668 when Sweden established its central bank, then 1694 England, 1800 France, 1811 Finland, 1814 the Netherlands, 1816 Austria and Norway, 1818 Denmark, 1846 Portugal, 1850 Belgium, 1874 Spain, 1876 Germany, 1882 Japan, 1893 Italy. As economies grew, financial systems became more complex, both in terms of financial superstructure as well as financial instruments. The nature of financial transactions became more complex and the volume of transactions increased considerably. This led to creation of an appropriate payment and settlement system, which had to be managed by the central bank. Again, as the participants in the banking system grew, the central bank assumed supervisory and regulatory role. It also assumed the role of nurturing and developing financial system in line with the financial requirements of the country. And at the same time, risk management systems also evolved. This table will give you the differences in the development of central banks in developing countries as compared to a developed country. In a developing country, the first apparent disparity is that it has poor infrastructure, whereas in a developed country, it has well diversified and strong financial superstructure. In a developing country, there is not much financial widening and deepening, but a developed country has achieved financial widening and deepening. Developing countries, people prefer currency as the means of payment, as compared to a developed country where checks and drafts are used as a means of payment mechanism. Developing countries have a low currency to deposit ratio, which goes below 10% also, while developed countries have a high currency to deposit ratio and it goes up to 80%. In a developing country, significant part of economic activity is from informal markets. But in a developed country, the economic activity is from organized markets. So in a developing country, the central bank plays a development role. That is, it promotes the spread of commercial banks. While in case of a developed country, commercial banks had already been there. So the central bank played the role of lender of last resort. And finally, the advantage of a developing country is that as latecomers, these countries had the advantage of observing developed countries' systems and drafted accordingly. While in a developed country, the central banking system grew incrementally as per the requirement of the economy. Let's come to the Reserve Bank of India, created by the RBI Act of 1934 and started functioning from 1st April 1935. The preamble of RBI Act 1934 states, whereas it is expedient to constitute a Reserve Bank of India to regulate the issue of banknotes and the keeping of reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. Though originally privately owned, since nationalization in 1949, the Reserve Bank is fully owned by the Government of India. And in case of a difference in opinion between the RBI and the government opinion is expected to prevail. Let's discuss the main functions of the Reserve Bank of India. Monetary authority. So the RBI formulates, implements, and monitors the monetary policy with the objective of maintaining price stability and ensuring adequate flow of credit to productive sectors. The next function is regulator and supervisor of the financial system. So the RBI prescribes broad parameters of banking operations within which the country's banking and financial system functions. And the objective is to maintain public confidence in the system, protect depositors' interest, and provide cost-effective banking services to the public. The next function is as a manager of foreign exchange. So the RBI manages according to the Foreign Exchange Management Act of 1999 with the objective to facilitate external trade and payment and promote orderly development and maintenance of foreign exchange market in India. Another function is that of issuer of currency. It issues and exchanges or destroys currency and coins not fit for circulation. So the objective here is to give the public adequate quantity of supplies of currency notes and coins and in good quality. It also plays a developmental role where it performs a wide range of promotional functions to support national objectives. Other related functions are it is a banker to the government, it performs merchant banking function for the central and state governments and also acts as a banker. And it is a banker to banks, maintaining banking accounts of all scheduled banks. RBI also has 6 training establishments, the College of Agricultural Banking, then the Bankers Training College, Reserve Bank of India Staff College, National Institute for Bank Management, Indira Gandhi Institute for Development Research, Institute for Development Research in Banking Technology. Let's move to the roles of RBI. Note issuing authority. It puts currency into or withdraws from circulation. You must have seen that we do not use the 1 rupee note anymore. In place of that, we use the 1 rupee coin. You have also seen that the 20 rupee note has literally disappeared, and we have a 200 rupee note which we did not have earlier. Then it exchanges notes and coins of one denomination into other denomination as demanded by the public. Second, government banker. It provides governments all banking services such as acceptance of deposits, withdrawal of funds by checks, making payments as well as receiving and collecting on behalf of the government, transfer of funds, and management of public debt. It receives government deposits free of interest and is not entitled for any remuneration for the conduct of ordinary banking business of the government. The third role, it provides what is known as ways and means advances. These are temporary advances made to the central and state government in order to bridge the gap between receipts and advances. So it could be a normal or clean advance, which means there is no collateral involved out here. It could be a secured advance where the government pledges securities with RBI, or it could be a special advance granted by the bank at its discretion. In either case, there is an interest charge out here and it is at the bank rate. In order to know the latest bank rate, please visit the RBI site. Fourth role is that of offering overdrafts. This refers to the drawals of credit by the state governments from RBI beyond the ways and means advances debits. For the first 7 days, interest is charged at the bank rate. From the 8th day onwards, it is charged at bank rate plus 3%, and a commission is charged for rendering this service. The fifth role is that of a banker's bank. RBI controls the volume of reserves of commercial banks and thereby determine the credit creating ability of banks. You are familiar with cash reserve ratio and statutory liquidity ratio. So when banks hold a part of the reserves with RBI, it is their CRR, and when it invests a part of its cash in liquid assets, of course that is also defined by RBI, what is a asset in which the bank should invest, then that part is referred to as a statutory liquidity ratio. So higher these rates, higher these ratios, lower is the amount of cash available with the bank for disbursement as credit. And finally, in times of need, banks can borrow from RBI, and so it is also referred to as bank of last resort. RBI also plays the role of supervising authority. It issues license for setting up new banks, bank branches. It prescribes minimum requirements regarding paid up capital and reserves. It transfers to the reserve fund. Then there is maintenance of cash reserves and other liquid assets. RBI also inspects working of banks in India and abroad and investigates into complaints and irregularities. A Department of Supervision was created in 1993 and the Board of Financial Supervision was created in 1994. And as per the recommendation of the Narasimham Committee of 1991, supervision role was separated from the traditional central banking function. The next role is that of exchange control. RBI administers foreign exchange control so that it can help in conserving foreign exchange, use forex in accordance with planned priorities, and control flows of foreign capital. It manages the exchange rate between rupee and other currencies and also our exchange reserves. It interacts and negotiates with monetary authorities and international financial institutions like the Asian Clearing Union, International Monetary Fund, the World Bank, and the Asian Development Bank. RBI plays a developmental and promotional role also. It mobilizes savings and directs credit flows to desired channels in order to achieve the objective of economic development with social justice. Therefore, we have priority sector lending or concessional lending under different schemes. RBI also goes for amalgamation and mergers of weak banks with strong banks. It tries to ensure appropriate geographical distribution of bank branches. In 1962, a deposit insurance corporation was created. This was a measure of protection to depositors, particularly small depositors, from the risk of loss of their savings arising from bank failures. The purpose of creating this was to avoid panic and to promote greater stability and growth of the banking system. There's also a Credit Guarantee Corporation of India created in 1971. This takes affirmative action to ensure that the credit needs of the hitherto neglected sectors and weaker sections were met. The essential concern was to persuade banks to make available credit to not so creditworthy clients. In 1978, these two, that is the DIC and the CGCI, were merged to form the Deposit Insurance and Credit Guarantee Corporation. RBI, in its developmental and promotional role, also offers short-term finance at concessional rates through cooperative banks for seasonal agricultural operations and marketing of crops. This has enhanced the credit delivery and service capability. Let's take the example of NABARD, which was created specifically for agriculture and rural development. All special development institutions at central and state level were either created by RBI on its own or it advised and rendered help in setting it up. Then RBI also formulates prudential norms. It does intervention in the forex markets. It oversees the safety and soundness of the banking and financial system. RBI facilitated institutional finance by setting up of NABARD, National Housing Board, Exim Bank, and through these institutions it has provided short-term and long-term funds to the agriculture and rural sectors, small-scale industries, medium and large industries, housing finance, export sector. There is a Banking Ombudsman Scheme, 2006. As a part of its grievance redressal mechanism for hearing consumer complaints relating to certain banking services, RBI launched the Banking Ombudsman Scheme in 1995. With effect from 2006, it was brought under the Banking Regulation Act, and therefore it is known as the Banking Ombudsman Scheme 2006. According to RBI, the scheme provides an expeditious and inexpensive forum to bank customers for resolution of complaints relating to certain services rendered by all scheduled commercial banks, regional rural banks, and scheduled primary cooperative banks. The scheme was introduced with the object of enabling resolution of complaints relating to services rendered by banks. It facilitates the satisfaction or settlement of such complaints. And the Banking Ombudsman is appointed for a period of not more than 3 years. Normally, each state capital has an ombudsman's office, and the territorial limits of the ombudsman are specified. The complaint that can be raised before the ombudsman could be for deficiency in banking services, including internet banking, or with respect to loans and advances. And it is a quasi-judicial authority. You can see from here that for the states of Assam, Arunachal Pradesh, Manipur, Meghalaya, Mizoram, Nagaland, and Tripura, that is our northeastern states, we have one ombudsman whose office is located in Guwahati. You can get all these details from the RBI website. Thank you very much.